All right, guys, this is our last panel of the day. We only have one more session after this, which will be our workshops. This last conversation, our fireside chat, is where do we go from here? How to ensure that capitalism works for everyone. And I'm happy to introduce Nick Harris, who is an accomplished corporate executive, experienced in tech and innovation, business strategy, mergers, acquisitions, and operations. Welcome, Nick. Thank you for being here with us.
Hi there. Thank you, Morgan. Thanks so much for having me. So, as you just said, Morgan, this is the last chat of the day. I'm super excited to be here. And again, focusing on where do we go from here? How do we ensure capitalism works for everyone? And so the topics that we're going to dive into, there are really three topics. One, next wave entrepreneurs. The second one is policy and funding and disrupting venture capital. And we're going to really dive into some sensitive subjects here and make sure that we have some open discourse. And so I will be moderating. I currently work as a strategy consultant with the KINETIC team, and I am joined by two esteemed colleagues. So first is Melissa Bradley. She is co-founder of venture-backed Ureeka, a community where small businesses gain unprecedented access to the expertise needed to grow their business. She's also the founder of 1863 Ventures, a business development program that accelerates new majority entrepreneurs from high potential to high growth. In this role, she created a community of over 10,000 new majority entrepreneurs in just 3 years. She also serves as a general partner of 1863 Ventures Fund, venture partner at Next Gen Ventures, and serves as advisor of the New Voices Foundation and New Voices Fund, as well as the Halcyon Fund. She's also a member of the Fast Company Executive Board, Square and Forbes Small Business Advisory Team, as well as the Target Accelerators Entrepreneurs Advisory Council. We also have joining Seth Levine, co-founder and partner of Foundry Group, and has a career that spans venture capital investing as well as operational, transactional, and advisory roles at both public and private companies. Prior to co-founding Foundry Group, Seth began his venture capital career at Mobius Venture Capital nearly 20 years ago. Prior to Mobius, Seth held a variety of management and finance positions in both private and public companies. And when not spending time with his family, you might find him cycling, snowboarding, or mountaineering around Colorado and sailing off the coast of Nantucket. He's actually the author of The New Builders, Face-to-Face with the Future of Business. And so that book is currently on pre-order and will be available to all next month. So Melissa and Seth, thank you so much for joining us. I am humbled you are here today. How are you?
Great to be here. Thank you.
Thanks for having us, Nick.
Absolutely. So what we like to do is really have the last chat of the day and summarize some of the things that we've learned, but talk about a forward-looking future as it comes to funding. But first, I got to ask you, what did you think about today's sessions?
Absolutely amazing. I had a couple of meetings this morning, but I was multitasking, listening. I think you had amazing speakers, proud to know at least 80% of them. I love that they were honest. They came from a place of integrity. They were educational and aspirational as always. And by the chat, I think I probably enjoyed it just as much as everybody else who showed up to hear some of these folks for the first time.
Yeah, Nick, it was an amazing day. I feel just humbled to be a part of it, actually. I was joking with Melissa earlier. I was taking notes all day. I thought it was absolutely fascinating. It started great. I thought Philip in particular, what a great way to start the day, and it just sort of built from there. So kudos to you guys. It really was a fantastic day.
Awesome. So
hopefully we can live up to being the capstone for that.
Well,
I'm counting on you, Seth. I'm counting on you, man.
Right back at you, Melissa.
Oh, well, thank you both for the feedback. I couldn't agree more with all the insights and inspiration from today and education, frankly. So what I'd like to do is ask you a few questions. I'd like to get to know you both as individuals and some of the work that you're doing. And then I'd like to dive a little bit deeper and talk about what's in the future and get your feedback. So why don't we start with you, Melissa? What exactly is Ureeka?
So Ureeka is a combination of many years of trying to figure out what is the best way to scale the opportunity for new majority entrepreneurs. There are amazing accelerator and incubator programs, but one of the challenges I've had even running one is that the financial model is one to many, not one to one. And as much as we want to say, oh, all Black entrepreneurs are the same or all women entrepreneurs are the same, it's not true. There are serious nuances when you start to grow by geography, by sector, by desire, by experience, by skill. And I found that too many programs and too many folks were all about one size fits all. And when you are an entrepreneur of color, particularly someone like me, Black, gay, female, there is no one size fits all. Every time you show up, people think like you've walked off the zoo lot and you're purple and green and they've never seen you before. And so it's really important that when entrepreneurs want to grow and scale their businesses, they get curated support. So Ureeka is really the culmination of years of my work and my co-founder saying there's got to be a way to create a platform that entrepreneurs can come together and find each other, find experts through coaches and mentoring, and find access to vetted curriculum that is not one size fits all based on one of the 4 archetypes that we've created for the entrepreneur members. And so we're just over a year and a half old. We have about 11,000 members on the platform and been truly blessed and fortunate that over 80% of our members are women and women of color. So we feel like we've done a good job of engaging them in a trustful community that is supportive. And we've seen some amazing successes so far, despite all the negative statistics that we hear about COVID. I would say that folks who look like me are pretty darn resilient business owners because COVID-19 is not new for us. The ebb and flow of cash flow, the challenges of family pressures and health issues, the lack of access to capital, the ignorance of policymakers around our unique needs, that's not new. So this was an opportunity for us to start to break that mold.
Well said. So I love what you talked about, the 4 archetypes, and then you've got this infrastructure of support. So then how did you get to the point where the platform offered funding? Was that part of it early on, or is that something that was added on a little bit later?
It is truly because of COVID and George Floyd. I think everybody knows it's pretty hard to aggregate small businesses, and in part because there's so many daggone choices. And so when a lot of the companies like Facebook, Salesforce, and Google were looking for a place to be able to deliver money, but also realized that money is great. But I remember we had a pitch competition many years ago, and a woman won $25,000. And in my normal monthly check-in, finally about the 3rd month in of check-in, she kept saying, "Oh, things are going well, things are going well." I said, "Well, finally, what'd you spend the money on?" She goes, "Girl, I ain't spent that money. I didn't frame that check. I don't know what to do with that. I have more than $25,000 of expenses, so I'm not really sure what to do with that." So I think what happened was there were many places they could deploy grants, but they realized that giving somebody a check was not going to solve their problems. And so we were able to deploy over $100 million in the first 3 months post-COVID and George Floyd to over 15,000 businesses because of those grant programs. And fortunately for us, those programs still continue. We believe that based on our conversations, they'll continue for several more years. And so we've been fortunate where our traditional pathway to capital would have been our referral network of angels and venture capitalists, but we've been able to provide non-dilutive funding to several thousands of entrepreneurs across the country and hope to be able to do more.
Excellent. That is fantastic to hear. Now, is that only as grants, or are you also investing directly from Ureeka?
Right now, it's just through grants, but we have a network of angels and venture capitalists that we work with that we have indeed had many of our businesses funded. If people are familiar with Black Girl Sunscreen, we helped her get her first $1 million. And then we also have several, ironically, of the Shark Tank companies that have come through who have received money. And what the investors have now said is, great, they got the money. Now, if you could help them get on track and actually execute and create strategies and build a business. So we have a lot of different network partners that we're able to facilitate capital.
Oh, that's terrific. So for those listening, what size grants are we talking about?
They range. They've been anywhere between 5,000 all the way up to 15,000. We don't set the amount. The company set the amount, and I can tell you that there'll be many more coming. So come join us at Ureeka.biz, or at least sign up for the newsletter. We've got 90,000 entrepreneurs that track the newsletter, and I'm sure there's many out there because there's a lot of grant programs right now. So I would say it's a unique opportunity for folks to figure out, how do I get my friends and family round through grants that oftentimes we are unable to access to be able to fuel our growth.
Okay, so I've got some friends that are entrepreneurs. If they go to that platform and they log in, what is it going to take for them to qualify for one of these grant programs, especially from some of these big providers that you mentioned, such as Google and Comcast?
So the nuances have varied. I mean, it was great. I was so happy to see Comcast rise on this morning because they're actually a partner of ours now in their next program. And so the criteria vary. So for example, Comcast Rise, they're looking for BIPOC entrepreneurs. That's it. For the Salesforce grant, it was looking for Black entrepreneurs. For Facebook, it was entrepreneurs of color. So the companies decide who gets the money, but most of them, I would say, have been, 99.9% have been focused on historically marginalized and overlooked communities, whether they be women, people of color, across the full rainbow spectrum.
Okay. So I read an interesting story that you were actually denied an SBA loan when you wanted to start your first business. So how did you eventually fund that? And did you learn from that? And did that inspire you to do some of the work that you do today?
I learned a lot from that. I was like, who said this federal agency was designed to help me? So when I graduated, I worked for a year in corporate America and I hated it. And so I wanted to start a business. And I went to the SBA after I did a business plan. And for all the young people, that's when we actually went to Kinko's and put spiral bound on them, and you put it in the mail, you delivered it. And the woman said to me, we will not give you a loan because you have 3 strikes against you. And I was like, okay, let's go. What's 3? Come on, I got this. And then she started with, I'm Black, I'm a female, and she didn't know any successful Black women in financial services. So that was the end of that. And when I got to the bottom of the building, I said, if I am ever successful, I will make sure this never happens again. And so the company ended up, I just self-funded it. I started doing what I'm sure a lot of entrepreneurs do. I was doing some odd jobs. I was doing some resume stuff for people. I was walking dogs. I was doing a whole bunch of stuff just to keep the company going. And finally, we made a pivot from being 1 to 1 to 1 to many. And we got a contract with the PTA. We got a contract with some fraternities and sororities, and it blew the business wide open. And 2.5 years later, it was sold.
Oh, that's terrific. And so a great story of kind of that hustle for, entrepreneurship,
Yep.
but also you turned a profit. So, from an economics perspective, it was a sound business strategy that you were able to actually execute on. So, but there's this social innovation piece as well that kind of factors in when you start thinking about the economics, right? And so what kind of stories did you learn, running the White House social innovation under President Obama?
Oh, I learned a lot. I think the 3 major takeaways. First of all, very humbled to be a part of that. It was a very unique administration and an amazing milestone in our history. The purpose of the Social Innovation Fund, which spanned out of the White House, but there were many others and other agencies, was really to spark and catalyze innovation that was proven. And so the 3 lessons I learned were that, 1, some of the best innovative solutions come from the community, not policymakers, not legislators, but when they're community led. The second thing is that it takes a lot of money to really solve a problem. And too often philanthropy and the federal government, even collectively, have underinvested. And that's a real issue. We know that McKinsey has come out and said the cost of just the SDG goals, which, let's be clear, don't cover everything, we do not have enough money from. And so the second lesson was that we've got to figure out how to engage the private sector. And I was fortunate enough to be there when we created the whole social impact bonds and pay for success movement, because I think we finally figured out a way to fill some of those financial gaps. And I think that the third biggest takeaway is that you have to be patient. We had a methodology where we would impose randomized control trials, and we all know the pros and cons of RCTs. But it showed that most of the changes did not happen in the first 3 years, that it really took years 3 to 5 and then 7 to begin to see change, which I think is significant, because when we talk about where do we go from here, I think we have a unique moment, but we are years away from making it a movement. Because obviously the systemic barriers that many of us are facing are institutionalized, and let's be clear, in some cases very well funded by folks who don't want people like me to be successful. So we have to recognize that it's not Sisyphus, but it's an uphill journey, and we need to pace ourselves emotionally and physically, but we also need to make sure that we have enough money because the churn rate in the beginning is pretty significant. But after 5 years, most of the interventions that we invested in were successful.
Wow, that's great to hear. So it sounds like my takeaways there are public-private community partnerships, patience,
Yep.
and actually realizing the expensive things and what an investment time horizon looks like and what it actually means to see something that's fruitful. Excellent,
Absolutely.
excellent. So glad you're here. So Seth, question for you. We talked a little bit about your book earlier, The New Builders. Why did you write that?
Absolutely. First of all, it's great to have Melissa here. There's some things that she touched on that we talk about in the book. I hope we get a chance to talk about a little bit more, because they're so important to thinking about sort of the future of capital and the future of entrepreneurship. We wrote the book. I wrote the book with a journalist friend of mine, Elizabeth McBride. And we wrote the book because there's some fundamental truths about entrepreneurship in America today that just simply aren't being told, and I think in a lot of cases aren't being even recognized. Starting with the fact that entrepreneurship is to some extent in a state of decline. Philip talked about this in the very first session today, but the truth is that for the first time since the government started tracking the number of net new business starts, which started in the 40s, the net new business starts in the US were negative for a few years in 2010, 2011, 2012. And really, if you look over the last 20 years, or so, entrepreneurship has been quite flat. And that's surprising. It's also in part surprising because of the second trend that I think is really challenging, which is that Silicon Valley has just overtaken our view of entrepreneurship in a way that we think is toxic. And we no longer celebrate the breadth of entrepreneurs that we used to, going back all the way in our history as a country. Really, everyone was an entrepreneur sort of way back, and we would celebrate and describe people that owned a corner store or that were a merchant as entrepreneurs. And we're less likely to do that now because Silicon Valley has just sort of taken over this mind share, which I think is problematic. Related to that is one of the third point that we talk about, which is that we've become obsessed with size. And everyone's talking about sort of unicorns and these sort of billion-dollar valuations. And I think that that's a byproduct of Silicon Valley taking over our mind share. It's also a bit of a byproduct of the venture capital model being the model that people look to, which has really not been a very effective model for generating broad-based success across different entrepreneurs. You could argue whether it's an effective model at all or not. About 75% of venture funds fail to return capital, but even that aside, it's an effective model for finding a very small number of highly successful companies. One of the things we like to talk about is, really, if you think about sort of a broad-based economy, we need to create not unicorns, we need to create camels, right? Much more common, much more robust, hardy, but a broader set of successful businesses. And that's really not what venture capital does particularly effectively. And then lastly, and this is really important, and it may not be a surprise to the people on this call and in this forum, but it's certainly been a surprise to the many of the people that we've shown these statistics to. But increasingly, the entrepreneurs that are starting businesses are diverse. Specifically, more women are starting businesses than men. More than half the new business starts are from women, and in particular, women of color are starting more businesses. And the result is that businesses today are more diverse, more likely to be started by women, more likely to be started by people of color, also more likely to be started by people who are a little bit older. Actually, the age demographic of people starting businesses that is growing the fastest are people who are 55 and older. So that's why we wrote the book. We felt like these were really important trends to be talking about. And we looked around and felt like people weren't talking about it. So we decided we would write about it and tell some of the stories. So we call this next generation of entrepreneurs new builders. And we describe this sort of army of new builders. We met many of them across the country in our research. We highlight 15 or 20 of them in the book. We also talk about some of the new financing models, some of the other things I'm sure we'll talk about in this panel. But that was fundamentally why we decided to put pen to paper and dedicate a couple of years to researching and then writing the book. And I should say that really COVID hit right as we were starting to write this up. And as everyone on this call knows, COVID disproportionately affected businesses that were run by people that are Black, brown, and female, by the new builders. And so I think there's never been a time where it's been more important to talk about how the landscape is shifting and how we need to do a much better job of supporting with capital, but also, as Melissa talked about, supporting with other forms of support, mentorship, advice, counsel, et cetera, this next generation of entrepreneurs.
Wow, that is fantastic. So thank you for sharing that. I got an early copy of that book. Thank you for that. And even though it's not out yet, I would recommend everyone pre-order this book. It's fantastic. One of the excerpts really stood out to me as you start talking about the new builders on the business side being more diverse in many ways. Now let's talk about kind of the funding side. And so in the book, you say, as the people starting businesses have changed, our systems of finance and mentorship have failed to keep up. For the first time in history, the majority of entrepreneurs don't look like either the past generation of entrepreneurs or the people who control the capital and systems of support that are enablers of entrepreneurship. So first of all, that was pretty powerful. I think every time I read that, I get chills. In a perfect world, what do the new systems of finance look like? How do we take small incremental steps to really build those new systems? And what does that mean for the old systems?
Yeah. Wow. How much time do we have? This we could do an entire forum on this. First off, I said this to you in our private room when we were chatting, but I want to give you props publicly. I've sent the book to probably, 30 to 50 people have had copies to pre-read. I think what you just said is one of the most important things we talk about in the book, and you're the first person to pull it out and ask me about it. Because I think this is a really important trend. And what's interesting is exactly what you just described. The people that are writing checks and we talked about this actually on someone talked about this on one of the other panels. It's not just the people writing checks, it's the people writing checks to the people writing checks, right? So we've got a couple layers here that we need to solve for. And those people look like me, for lack of a better way of saying it. They're older white guys. And increasingly, I think what we're seeing, and I think we see this in some of the failing of the venture capital model, especially as it relates to funding entrepreneurs of color, is that that has not done a good job of funneling money broadly. And there's a bunch of reasons for that. I want to call out a couple things. Kobe said this in his panel. I just want to really emphasize this because I've spent a lot of time thinking about it. There is not a pipeline problem. I just don't believe it. That's what lazy people say when they want to give you an excuse for why they haven't done a better job of supporting diverse entrepreneurs. There's a network problem and there's an effort problem. And that's really it. And I think that those are things that we need to try to solve for. But we can't solve the network problem if we don't solve the effort problem, if we don't create opportunities for people with capital to better understand the overall market dynamics and understand how to deploy that capital. All of that said, I don't spend a lot of time thinking about venture capital, even though I'm a venture capitalist. I spent some time, is my day job. But that we've talked about this before. Really only about 1% of companies take money from venture capitalists. It's a lot of money. It's important. We should absolutely do a better job of diversifying that. And if we have time, we can talk about some things which we've been trying to do at Foundry even to do that. But I like to think about, and then as we heard in another panel, only about 17% of businesses take money from banks. So that leaves about 80% of the rest of businesses that aren't taking money from anyone. And that's problematic to new builders for a number of different reasons, starting with the fact that there's 400 years of systemic racism in the US has led to this massive wealth gap, right? The average Black family has 1/10 the wealth of the average white family. And by the way, that is true whether you control for any factor you want to control for, education, other demographic, where you are in the country, et cetera. It's just, we have just created this system where we have not been able to create the kind of generational wealth for people of color that we've been able to create for white people. And that's problematic for this 80%, because that's by and large how these businesses are started. They're bootstrapped. They're started with friends and family money. They're started, as Melissa described, with selling customers and generating revenue early and being scrappy. And so all of that should continue, but I think we need to focus on two things. One is the 17% of the world that takes money from banks. We need to do a much better job of expanding access. We are killing the banking system in the United States right now. 20 years ago, there were 14,000 banks in the US. Today, there are fewer than 500. Yep. There's a bunch of reasons, and maybe we should talk about that later, but and that's particularly hurt some of the minority development institutions, so banks that were more historically focused on lending to people of color. It also has really affected the CDFI, Community Finance Development Institutions, which it's been such an important part of the community banking system, and we're letting that kind of wither on the vine, which is really unfortunate. So there's some things we can do in that 17%, and then what I'm really interested in are some of these new models, and I think Melissa would be a great person to talk about this because she understands this world well. But new models that are trying to extend and expand capital access to that 80% of entrepreneurs, and I'm thinking about revenue-based and profit-based financing models. Collab Capital is a great example of a firm that's doing some really interesting things around that. There are a bunch of firms that are doing that. Founders First Capital, Kim Folsom, is doing some really interesting things on the West Coast about that. So I think that's a really interesting area to sort of think about, how do we expand that capital? And then how do we expand the institutional investor base behind that capital? I'm really focused on thinking about ways to move this type of capital investment out of the impact bucket and into the investment bucket, right? Can we just cross out impact and just make it investing? Because I think that the pool of capital available that is just investment capital, no strings, is 10 to 100 times larger than the pool of capital that's available to impact investing. And so anyway, I'm not sure if I'm exactly getting, Nick, to the questions that you, or the specificity level that you want, but those are the things that we think about. And we do talk about in the book. There's a whole chapter about sort of policy ideas, some of which are, and a whole other chapter about new capital models that talk about some of these trends and some things that I think we can spend some more money and some more time exploring.
No, thank you so much for that, Seth. That is fascinating and completely agree, especially on a lot of the data points on the disadvantages of capital in different groups and how people might view impact capital. So those are things that we definitely should dive into a little bit more. I really appreciate your passion. I'm going to ask you a personal question, however. How has being the parent of Black children changed your perspective in life? And did that change your perspective with regards to venture capital?
Yeah, I'm pausing only because it's not something I usually talk about. And I applaud your due diligence. I don't not talk about it, but I don't generally talk about it. I don't think I've ever said anything sort of publicly about it. I have 3 kids, and two of my children are Black. I obviously haven't lived the experience of being a person of color, and I'm extraordinarily conscious of that. But I've lived really close to that experience, and I've had a chance to see things in a slightly different way because I've been with my daughters when we've walked into Nordstrom's, and one's gone one way and the other's gone the other way, and my daughter, who's Black, has been followed. Like I can see that. I see how people react to my family. I understand we are a little bit different, but just I've experienced that discomfort and that sense of sort of feeling like I don't belong because of that, and I think it's affected me deeply. And so, it's hard to describe how it's changed me because it's like it's just a part of me now. And so my children are a little older; they're all teenagers. So we've been a family that has had this experience for a long time. So and you're probably hearing it in my voice. Like it's very, very personal and to me, which is I think in part why I felt so passionate about writing this book, because I felt like these are stories that need to be told, and I have privilege in so many ways. I absolutely had the privilege of the platform because of what I've done and my connections and all of the things that have come with being in venture for 20 years, not to mention success and money and things like that. I had the privilege to be able to have this platform, and so I felt like it's important to use that platform for something that's good and important, which is frankly why my wife and I are investing back into Black-owned businesses and other funds that are trying to fund not just Black-owned businesses, but fund more broadly speaking businesses with different models. It's been important to us, I think, in part because of our lived experience.
Yep.
Well, I appreciate you being vulnerable and actually sharing that with us, and it really means a lot. Thank you. You said you and your wife do some funding. So speaking of some of the funding that you've done, Tyra Banks actually wrote the foreword for your book. She mentions that even she has had difficulty in her entrepreneurial journey, raising funds, and she showed a lot of gratitude for the investment and belief in your belief in her company, Smize. How did that investment come about?
Yeah, Tyra is a force of nature. I mean, it's been awesome to get to know her. I just like you, I was totally surprised that she had any trouble funding her business, and she talked to me about it. She actually writes about this in very personal terms in the foreword to the book about her struggles, even though she's well known and well connected, but her struggles being taken seriously, frankly, as a businesswoman. And I think that I really appreciate her willingness to be out there and to really talk about it in that way. And so. I met Tyra through mutual friends. I obviously knew who she was, and I was thinking at the time about trying to meet some well-known Black women who were entrepreneurs, and I knew her as an entrepreneur, as much as I had known her as I guess a model. And so I was able to network in to meet her, and we spent some time talking. And this was probably about maybe a year ago now that we started this conversation. And she was telling me about her business, and then she told me that she was struggling getting her business financed. And I said, that's silly. Like, why don't we go fix this? Like, if I'm literally writing a book about why it's hard to fund businesses. I have so many restrictions about what I can personally invest in just because of the way our fund works and the way the SEC describes what we can and can't do, because we're a registered investment advisor at Foundry. But ice cream was the type of business it was outside of what we could do at Foundry. So I knew I could do it. And so I got some friends together, and we put together sort of an initial funding for her that we've now built upon. And then as part of this conversation, it sort of naturally built up to like, hey, Tyra, I'm writing this book. I thought about maybe we interview her and sort of include her as part of what we talked about in the book. But I actually thought it'd be more powerful to have her voice stand as her own. And it's funny too, because the way that forwards often work, I actually sent her like a draft essentially that Elizabeth and I wrote, and she sort of laughed about it and was like, no, like this is like good job, and I'm going to take a couple snippets, but like I'm going to write this myself, and this isn't really kind of what I want to say. And I was like, awesome. I just wanted to give you like a little kind of nudge in the right direction, and then like truly like 24 hours later at like 3 a.m, she sent me back what ended up being the forward. And it was it really moved me because it was so deeply personal, and I think showed a lot of guts to be willing to tell her story. But she talks about owning her fierce passion, right? And owning her story. And I think it was really important to her to write it that way.
Yeah, absolutely. I mean, and she is, like you said, a powerhouse. She's a force of nature. And she continues to be a very successful and resilient Black entrepreneur. It's kind of sparked a thought. Melissa, you had some research that indicated Black entrepreneurs tend to spend $250,000 more than white entrepreneurs to start the same business. What are some ways that we can change that reality?
Yeah, well, first I want to just thank Seth for sharing that story, because I think we tend to believe that this doesn't happen to everybody. And so if Tyra Banks can't raise money, then who the heck can? Let's just be honest about that, right? Proven franchise, clearly popular. So I think it's universal. The research was done in part, just to give a little bit of context, because we wanted to figure out what was holding up investors from investing in Black businesses. And this was not the original research. The original research was to really dig under the hood. And what we found, and I'm sure Seth can relate, LPs didn't want to share. They didn't want to share what was really happening under the hood. They didn't want to share how hard it was for Black businesses to scale, because money doesn't stop structural racism. Money doesn't stop customers not coming to you because they're Black. Money doesn't open doors and say, let me get your product on shelves. So that was the original impetus. And what we realized was that some of the hurdles that were causing a different type of scale and growth pattern for Black and brown entrepreneurs was because it costs us more to start a business. And those costs are both direct and indirect costs. So having worked in Treasury under Clinton, unfortunately, I'm sad to say, having regulated minority depository institutions, it is legal for banks to charge different interest rates. And Black entrepreneurs are charged anywhere between 1.5% to 2.5% more. We don't get into a variety of programs where things are subsidized for us and everything is free. And so there's a lot of right reasons why it costs us more. I don't know how to change those costs moving forward, because I don't, unfortunately, have a magic wand that stops structural racism. But what I would like to have happen is for people to know that statistic and build it into the financial models they create, and recognize there has to be a different glide path for Black entrepreneurs. I started a tech company. We are venture backed, but less than 20% of all Black entrepreneurs are tech companies. So why do we keep creating all these new venture funds when most of them are not prepared to absorb it? We need to understand that, at least from my perspective, the entrepreneurs we work with, the 3 most important things for Black entrepreneurs is, 1, being successful, but not because they want to be famous, but because they want to change their current conditions. 2, that this is a community effort. There is not a single entrepreneur that I've met that has not talked about, I want to create jobs. I want to give back. I want to get those brothers off the street. I want to be able to employ Pookie or whoever. And so this is not a solo effort. This is a community effort. And the third thing is that we're going to be successful regardless. So this is really a privilege for you to join us on this journey, not a handout, because we're going to make it. The scale may look different. Are we going to have the same number of unicorns? No. Are we going to have a high level of $100 million companies? Absolutely. And so I think the takeaway moving forward is that we have to understand that structural racism is not just this amorphous thing, that it has real implications in terms of impacting not just how do you move up a career ladder, but how are you able to grow a business. And for me, this journey is not because I'm Black. This is because, if, to Seth's point, the fastest growing entrepreneurs in this country are people of color, and we are the largest demographic, the economic security of this country depends on us. Now, I know that scares people. probably scares a lot of people who look like Seth, but Seth's not afraid, but it scares people. And so this is not like, well, let's create different systems. This is, we are the fabric of this country from day one. If you continue to disinvest in us, it is a real cost, i.e. $16 trillion, what is borne by this economy. And so all that is to say, moving forward, we need to recognize that not every business is the same, that our current financial systems don't always work for everybody, and we need to think outside the box. We need to not just do one size fit all and recognize nuances around sector, geography, race, gender, etc. And we have got to Seth's point, really create a glide path. The fact that CDFIs are there are great, but they stop at 100 grand. And so the valley of death for a Black entrepreneur it just goes out. And some people don't make it out. And so we've got to think about how do we really re-engineer the financial system? How do we pull policy levers to allow individuals and accredited investors to have more options? It was great to see Cheryl from Republic on here earlier. Obviously, PopCom and what Dawn has done is absolutely amazing, but we have got to create more institutions so that we have more choices and more levers to pull so that we can create curated, successful experiences where entrepreneurs get the type of money they need when they need it at the cost that their business can actually afford for the duration needed so that they actually can generate a return.
That makes a lot of sense. And so there's another quote that you have, and I'm wondering how or if it fits into that mindset around some of these smaller institutions and what we have to do as a community. Now, you said venture capital is overrated, considering your background and experiences and the fact that it's going to take a long time for these depository institutions to really catch up. What makes you think that, and where should we look?
Well, having been one, and I guess still serving as one, it is overrated. I think we get a status that is like we actually know what we're doing, and most people don't. I could probably have better luck going to Vegas, betting some of the money that these VCs have had. It's a gamble, and you don't know. And so, to me, if you have that amount of risk capital that is coming out of pension funds, then can we distribute it across multiple platforms to ultimately de-risk the underlying instrument? I think that it's overrated because one, people think it's the end all be all. I think two, at least what I've seen respectfully, is that not a lot of venture capitalists have the level of expertise. Money is a means to an end. What most entrepreneurs need is guidance and direction on how to make decisions, how to create strategies, and how to create systems. Money doesn't do all that. And so with all due respect, VCs are really good at writing checks, but it doesn't mean they can operate a business. And I will say that I have the title of an entrepreneur snob. If you haven't run a business, don't talk to me. If you have never had to leverage your insurance policy to make payroll, don't talk to me. If you have never had to look somebody in the eye and say, I can't pay you right now, but trust me, and you get them to move on, that's what entrepreneurship is about. It is not an evergreen bank account that just says funnel you forever and you never make any money. And so I do think that we have to understand venture capital is overrated and that has not been successful in creating significant wealth or jobs for a large swath of people. It's made a few people even wealthier with a bunch of zeros that, let's be honest, they didn't need. The reality is that many of the business in Silicon Valley, and I'm sure Seth surfaces, have actually got money from the government. You think about Dell, you think about a lot of those were SBIRs, TTRs. And so the opportunity and the belief that venture capital solves all, no, it is, we need more curated tools that appropriately align with the business needs to be able to fuel their growth through investment. And I think what's happened is with all these television shows, we are laser focused on a tool that, with all due respect, is designed to weed people out. It is not designed to bring people in. And so as a finance major, do I say venture is racist? No, I think venture capitalists are racist, but we have to understand venture capital is one asset class of many, and I don't know why we overweight it when we have so many other options we could be choosing from. And Seth named it. Jules, a good friend. 1863 Ventures, we do revenue-based financing because CPG companies don't need venture capital. And so we have got to educate ourselves on what is the full spectrum and then figure out where do we need to overinvest so that there's equal access to all those vehicles instead of everybody running across country to Silicon Valley who honestly is not really vested in their job growth, right? They're vested in an exit. And I think that's the other piece. There's a gentleman, Sai, who's the COO of Honeypot, and we had a conversation. He said, the fundamental problem for Black entrepreneurs is that capitalism is counterintuitive to our beliefs, right? We thrive and build things for community, not for individuals to get wealthy. And so why do we continue to force this ongoing friction when we have many other opportunities amongst our own institutions, from CDFIs to MDIs to nonprofit loan funds to revolving loan funds? There are so many options. And so we've got to figure out how to level the playing field so that we can actually build and grow more businesses.
Yeah, no, that makes sense. My one huge takeaway I heard there was they're not invested in their jobs, they're invested in the exit, right? So it's not about the community piece, and that is huge takeaway. And then you mentioned a little something about MDIs, which is a great segue to something Seth mentioned earlier in the conversation as well. And so in your book, you talk about the death of community banks and how this impacts lack of capital for the new builders, right? Earlier, I think you shared a statistic that so many years ago, there were 15,000 different banks, and now there's 500. Those statistics are everywhere, and they point to things that are very, it's a dire, right, situation right now, especially for those who aren't focused on just the exit of the unicorns, but the camels and the interest of the community at whole. So this has been especially relevant for MDI, so those minority depository institutions. Many are dying, and the KINETIC team members have actually watched sessions on Capitol Hill to try to save them. Do you think there's opportunity in the fintech space to creatively meet the needs of these new builders, whether it be like a Cabbage or Greenwood or Vero or something else?
Well, I think so, but there's an asterisk here, and I want to just emphasize something Melissa said, and this is something that we talk about a lot in the book, because new builders, by and large, are very connected to their communities. And I think that's part of what gives them power, right? It's not just about writing a check and getting to an exit. It's really about building a business that they're passionate about, and doing so in the context of community. And that comes through in a bunch of the stories that we talk about. And I think the reason that I've got this, I mentioned this asterisk with Cabbage or even Square or some other these kind of big platforms, is that as they get bigger and bigger, one of the challenges with the banking system is that we created a bunch of regulations around the banking system because a bunch of things broke. A lot of regulations are appropriate, right? Because people sometimes behave badly. But we've sort of turned banks into utilities, and that's been a problem. And so there's been this consolidation in banking. 80% of all deposits are held by the four big banks, and they're very algorithmic in terms of how they think about lending. And the problem with that is the algorithms are racist. We talked a little bit about that in a panel, a couple of panels ago, about how Equifax and others are trying to change some of the ways that some of the inputs to those algorithms have behaved in racist ways. But the truth is that, and we know this from statistics, the Fed puts out data on this, and Melissa described several of them. She's obviously been quite close to it with her work at Treasury. But the Fed has studied this, and the truth is that people of color, they apply for smaller loans because they don't think they're going to get bigger loans. They receive a smaller portion of what they ask than their white counterparts. They pay more in interest rates than their white counterparts. And because of all of that, they're less likely in the first place to even apply for a loan. So the system itself isn't really working. And now we're consolidating it and making it like even more of a utility, meaning the computers are making decisions. And I think that's a problem, figuring out how to rebuild. And I'm not like a tear this down. And, I'd like to think about how do we shift the things that we're doing? There's a lot of money out there. How do we make it work and work more effectively? So how can we rebuild and shift some of that money over to the community banking system, change, as Melissa also pointed out, some of the rules on CDFIs. CDFI system was set up, the CDFI system predates the official CDFI Act that was like 1992. So they've been around for a while, but in 1992, that's when the CDFI system was set up. Like, we need to update some of the rules and regulations and access to capital, which would be great. I actually think we have a really great opportunity right now. President Biden just proposed a $2 trillion infrastructure plan. Well, guess what's infrastructure? It's airports and roads and bridges, but it's also the finance pipes and the institutions that finance our small businesses. And I think we would be smart to think about how we take some of that $2 trillion and put it to work helping American small businesses build back from coronavirus and from COVID. So there's so much here that I think is really important to talk about. And I already mentioned it, but I feel so strongly about this sort of middle ground, this 80%, and it's firms like 1863, it's firms like Collab that are trying to figure out how to serve those entrepreneurs. We need to figure out a way to make that more mainstream. I'll tell a story, which is almost an embarrassing story, but I'll say it anyway. Foundry invests in my venture firm invests in venture funds. And so we look at venture funds, and I was trying to get us to invest in Collab as a fund. And we decided as a group that it just it wasn't quite what we were supposed to invest in. I was not happy with that as the outcome, but it was what it was. The upside was I was able to put personal money in, so I'm happy about that. But that, I'm telling that story because there's this disconnect, right? And Bryce Roberts from NDVC, which is an early institutional effort at an RBI style model, just announced in the last couple of weeks that he couldn't raise money because he couldn't get institutional VCs, Foundry Group, to invest in that model. And I don't know, I've like banged my head against the wall sometimes. Like, why isn't that mainstream? What I hope is that these firms that are doing this now are really successful. I think it's the future of capital. I said that to Jewel when we met. And that becomes more mainstream for institutional investors of investors to put more money in, because I think that's how we can really drive change and drive significantly more capital to these markets. But smart capital, not capital that's just writing checks, hoping that this one company, becomes a unicorn and that's how they return their money. And the interesting thing about RBI models, if you look at the venture model, 66% of all venture investments fail to return even the capital that they invested. Fewer than 0.1% return more than 10x. If you look at the RBI models, they're much more evenly distributed. They have fewer of the outsized returns because the model is not necessarily designed for that, but they're much more consistent in generating return. And they do it for a much broader section of entrepreneurs. And again, these are all reasons why I believe, even though I've made my entire career in venture, I actually believe that that's the future of capital, not venture. Venture will exist. It'll continue and will be some subset of the world, but this has an opportunity to be a significantly larger asset class.
Yeah, absolutely. So I love what you said about smart capital, but still the persistent discrimination that actually happens in some of these large firms continues to happen. And so maybe they're not connecting some of the dots. Maybe there's a disconnect. And Melissa, sometimes I feel like there's a disconnect in the Black community itself. I mean, how did we get from the murder of George Floyd and an issue of police brutality to Blacks only get 1% of venture capital? I mean, it seems to be a disconnect or quite a leap. I mean, have you ever wrestled with this sort of reality and to reconcile how do we get from there to there?
Yeah, I mean, I think, one of the challenges is that there has been an historical underinvestment in just trying to resolve social issues. And it's interesting because we had this very conversation post George Floyd when everything was happening. I said, you know what? It's amazing all this money is coming to the community, but it's not like we're walking around with a blueprint of what to do with it. And my greatest fear was that all this money would come and we would not be afforded the opportunity to just stop, think, process, and create a plan. I think the challenge is that most Black folks, so let me speak for myself, I spend most of my days trying to survive, not even just thrive, but survive. I'm privileged, but I still get followed by the cops. I have kids I have to worry about. Every time I drive my car, I'm like, let's see how long it's going to take before somebody pulls me over because they think I shouldn't be driving this car. I go into malls, people follow me and follow my kids. And so I think that one is that we have to stop and pause and recognize the emotional stress and trauma that we have experienced as a community and give ourselves time and space to heal. And we need others to respect that we need time and space to heal. The second thing is because, and I will blame this solely on the charitable sector, the charitable sector and philanthropy has forced us to compete against each other as if police brutality is better than, less than, more than, less important than Black entrepreneurship. They are both equally as important to our longevity and our well-being, emotionally, physically, and economically. But we don't have the resources. We have intentionally been locked out of the system. So this week is police brutality, next week is entrepreneurship, another week it's education, and that's just absolutely absurd because it is the holistic nature of which these things continue to lock us out that allow us to not be able to advance and recognize our economic opportunity. And so the second thing is we need real investment in infrastructure so that the Black community can organize, engage, and plan. I am convinced all the answers are there. But the problem is you have organizations that are led by non-Black people who postulate our future and get millions and millions of dollars. But our think tanks, our research organizations are struggling with thousands of dollars. And so we are unable to take a leadership role in our own narrative and our own solutions because we are undercapitalized. And the final thing I would say is that we need more of these honest conversations. I just want to commend Seth for being able to share his personal life. I think that there is a misnomer that this is a Black and white thing. I think that the melding of communities and of people, this is an American thing. This country has been built by slaves. It has been stood up by slaves and immigrants. And it is about time that we recognize we need to let the people who built this country have a say in what happens to their prosperity. And that is not because I'm anti-Seth. That is because I believe our entire country will be better, particularly as the demographics show we are becoming a new majority. But I realize that scares people. And so I think we've got to be able to get past the fear and not think that this is a place around either or, but that really can be, everybody can benefit if you allow us to be successful. But there is such fear and trauma around that it's extremely, extremely scary for folks.
So it sounds like there's a lot of individual work that needs to happen and be recognized and valued. There's community, there's obviously venture capital and lending. We've kind of let the government off the hook. I want to talk about that. I know we only have about 5 minutes left, but I'd love to know your thoughts from both of you, frankly, especially if you've worked in the Bureau of Fiscal Service or a partner too. What should the Federal Reserve be doing? What sort of policies should we be putting in place that would catalyze more change sooner?
I think Melissa should start.
I'll start and I'll make it quick, Seth, because I know you've got some nuggets in there. I think that the biggest thing is that we need to repeat what we just did for PPP and think about it much more methodically and proactively around scale. What happened with PPP demonstrated some things that we didn't see before in the banking crisis, which says that the government can get its act together and deploy capital. The government has the wherewithal and the political structure to be able to move fast and nimbly, and that there is an opportunity to be able to make exceptions and change policy in an emergency situation. Because otherwise the PPP would have never happened. Like, there's no such thing as the Fed just giving out forgivable money. Like, it just doesn't work that way. So I think this, to me, was an opening that we need to blow open wide, that says the Federal Reserve not only is the keeper of our economic security, but has the opportunity to recalibrate equity within the capitalist structure and deploy capital in a targeted way by which it can be forgivable to allow people to grow and scale. So that can manifest through businesses, that can manifest through home ownership, that can manifest through access to college education. So I'm excited by what's there. The concern I have, and I will be critical, is I'm not sure the will is there. I don't know, I've served in 2 administrations. It's hard. But if we can't get this done now, when we actually have 51 votes, we are in trouble, because the system is not designed to be as responsive as it has been over the past several months.
So you're hopeful that we can push can do, but there's nothing we can do about won't do. So I think we have continued fighting to do there. Seth, your thoughts?
I think those are such great thoughts. The reality is we showed during this pandemic that if we have the will, we actually can get a lot of things done, and we can push a lot of money out. And that's why I brought up this point about the infrastructure package. I think we need to fundamentally think about financial infrastructure as infrastructure, right? Just as much as the roads that we drive on. And actually, one of the reasons that it makes sense to invest in roads and bridges is because multiple people get to drive on. They create more benefit. You spend $1 on a road, you create more than $1 worth of benefit across the economy. The same is true for financial infrastructure, especially financial infrastructure that pushes more money out to more people. So we talked about some of how we might do that in terms of increasing community banking. I think we should lower the regulations on some of these community banks. They've been forced to sell to larger banks because they can't actually comply with some of these regulations that probably do need to remain on the larger banks who have continued to foot fault a little bit. But I think that would be another thing that we should change. I really am interested in and applaud the government's easing of restrictions on the capital class. I think that this notion that only wealthy people should be a member of the capital class, I think is nonsense. And I think the reality is, in order to create wealth, people need to move from being just labor to being labor and capital. And I think one of the ways we do that is we allow more people to invest in more mainstream businesses. The side benefit of that is that also creates community, especially on some of these platforms where you can invest in businesses that are local. So you can actually go down to the storefront that you helped put money into, whether that was $100 or $100,000, and you can feel like you were a part of the community that they're creating. I think that's really important. I think expanding our ability to do that, we're increasing the limits. We talked about this a little bit. I think Dawn talked about this a little bit in her panel. We're increasing some of the limits on that are covered by some of these crowdfunding initiatives. So that's helpful. I think all of those things are good, allow companies to raise more money. And the last thing is that I think that there's some public-private partnerships we can think about. We talk about a few of them in the book. There's one that in particular I really like, just because it's been up and running for a long time, but it's the New Hampshire Community Loan Fund, but it pairs public money with private money. And so it uses public money in like the best way possible, because the public money unlocks more private money. I hate the government being a VC, and I don't really like the government being an LP, meaning an investor in a VC either. I feel like, one, that we've talked about, it only touches a small number of entrepreneurs. Two, it doesn't address the systemic problems with the venture model. And three, I don't really know that that's the role of the government. But for some of these more community-based funds, where you're pulling money from the community, and the government, whether that's local or federal, says, hey, for every dollar that the community invests, we'll invest $1 or we'll invest $2. And that's exactly what's happened in New Hampshire through the Community Loan Fund, and a number of other places as well. That's an effective use of federal dollars, and I'd love to see those programs expand. But we need to think about expansion in terms of like not even adding a zero. We're talking about adding like 4, 5, 6 zeros. Like this should be a multi-trillion-dollar market, not a couple billion dollar market.
Yep. And I would just add to that, though, I think, too, we've got to revisit CRA, Community Investment Act, because it has changed. It's arcane, neighborhoods have changed. What it was intended to do, I think, is still needed, but the way it's mapped out by geography, gentrification is happening. And then I think also, just to Seth's point, alternative credit scores. I did a lot of work with Fair Isaac at Treasury, and I think, we can open up all these dollars, but if we don't fix the distribution and pipeline problem, we're still going to be locked out. And so I do think we need to really leverage fintech platforms and others to say, how do we make decisions faster, and how do we take a wider swath of information that is much more indicative of one's creditworthiness versus what they created over 200 years ago based on people going around and counting bottles? It's just absolutely absurd.
Awesome. It sounds like we've got a lot of work to do, but there are a lot of pockets, and there are a lot of industries, government, et cetera, in our communities that can all join in to continue to drive this train forward. So Melissa, Seth, I want to thank you both. I thought it was going to be a great conversation, but it exceeded my expectations. Thank you so much for joining us today.
Thank you.
Thank you.
Thank you. Thank you.
Guys, thank y'all so much. That was unbelievable.